Warren Buffett, the interpretation of financial statements. Welcome back to Wealth-ology. For today's video, we will be going to talk about the interpretation of financial statements by Warren Buffett. Let's get started. Number 1. Consistency is king. Warren Buffett is infamous for announcing that the excellent retaining duration of an funding is forever. Here's a short quiz. Which product do you watch is much more likely to be famous nonetheless in 2050? A. Coca-Cola, which has been famous for as a minimum 120 years and has remained essentially the identical product for the entire duration. B. Snapchat, which has been famous for approximately 7 years. The solution is pretty obvious. When Warren Buffett is seeking out investments with a sustainable aggressive benefit, he desires to see consistency. Consistency in earnings, consistent low debt, consistently developing earnings, consistently low spending in capital fees and R&D, consistent profitability, and etc. To examine the final 10 to 12 months duration is a great start. However, as with inside the case of Coca-Cola, the longer the agency has been proving its durability, the better. Selling the identical product for decades, including Coca-Cola, has a super benefit for you because the inventory owner. It reduces fees with the aid of using plenty. It reduces manufacturing fees because the went to improve equipment decreases. It reduces advertising fees as advertising efforts are cumulative. It reduces fees for studies and development. It lowers the education fees of employees. It reduces the danger of getting out of date of stock, and whilst fees are decreased with the aid of using plenty, it approaches plenty extra cash with inside the wallets of shareholders. Not simplest are the fees decreased in those companies. However, you'll be capable to revel in compound hobby tax loose whilst your retaining duration is forever, which is something that has made Warren Buffett incredibly wealthy over the last 50 years. Number 2. What Warren Buffett is looking for in an income statement. To illustrate what Buffett appears for, we are able to use certainly considered one among his greater recent and biggest investments, Apple. The internet income of the organization has proven extremely good consistency during the last 10 years. Fair enough, it doesn't have the track file of Coca-Cola, and neither are its merchandise as long-lasting. However, the iPhone has seemed pretty comparable in view that its launched in 2007. Moreover, the income of Apple has grown at a regular pace. Another aspect that Warren Buffett desires to see in his investments is a constant and excessive gross margin. As a rule of thumb, you'd need to look a margin of 40% plus. We can see that Apple simply makes the reduce here. It's usually trailing to evaluate with competitions as properly so. As a factor of reference, Samsung had a gross margin of 45.7% in 2018, and Huawei had a margin of 38.6%. Having an excessive gross margin normally says something approximately the scalability of the commercial enterprise. That means that the greater the organization sells, the more the profitability becomes. This is a trait which you'd need to look in any commercial enterprise which you own. Finally, we need to evaluate the lowest line to the pinnacle line and calculate the internet margin. Companies with a long-lasting aggressive gain have better internet margins than their competition. Apple beats each Samsung and Huawei on this regard, and this is every other rule of thumb. A internet margin of 20% or better is normally a total sturdy and end result revealing that we're managing a easily run commercial enterprise. 3. What Warren Buffett is looking for in a balance sheet. Next up is the stability sheet. Warren Buffett loves to examine a parent known as retained income. The parent is being introduced to or withdrawn from every year, relying on if the business enterprise is reinvesting its internet profits or not. Buffett commonly loves to see a regular boom here. That means that the enterprise is worthwhile and that it identifies exact reinvesting opportunities. If we examine Berkshire Hathaway's retained income, for example, we see a completely robust boom over the last decade. Apple doesn't actually satisfy the standards of concerning retained income. However, one need to additionally think about that. Beginning in 2013, Apple started a pretty substantial dividends and proportion repurchase program. To the degree how successfully a business enterprise is the usage of those reinvested income. Go back on fairness can commonly be used. To calculate this, we need to revisit the profits declaration and evaluate the internet profits to the entire fairness of the business enterprise. Apple is displaying lots of power on this regard. That's partially an impact of dispensing a lot of the income to shareholders, however, additionally a signal of an enterprise with a long-lasting aggressive advantage. As a comparison, Samsung and Huawei aren't even one half of as worthwhile. In his 1983 shareholder letter, Warren Buffett indicates an incredibly extra state-of-the-art technique in the direction of measuring how successfully a business enterprise is the usage of its capital. He indicates that to calculate the so-known as go back on internet tangible assets, a one-third element to be aware is that the terrific enterprise seldom calls for lots of debt to expand. Usually, it could simply use the robust coin waft from the enterprise. Therefore, search for groups with little to no long time period debt. In a business enterprise pays off all its long time period debt, with much less than 4 years of income. It's in a pretty exact position. Apple certainly fulfills this criterion, and its competition do too. 4. What Warren Buffett is looking for in a cash flow statement. The third economic statement which you ought to dive into is the cash flow assertion. A coin go with the drift assertion differs from a profits assertion in that it represents real bits and bobs of cash. While the profit assertion is a degree of economic performance, this is cash being spent on properties, plant and system primarily. Look at what are the actual costs of income. You need them to be as low as possible. Lower than 25% is taken into consideration very good, and much less than 50% is acceptable. There are exemptions though, including whilst a corporation is creating a one-time charge to develop the business. Look at what the corporation is the usage of the cash for. Apple thus thoroughly here. In nearly each year, they have got capital cost of much less than 25%. The identical component can't be stated approximately its competitors. Also with inside, the coins go with the drift assertion, we are able to see the motive why the retained income from the stability sheet haven't been developing a good deal on account of that 2012. Apple has been dispensing a lot of coins to its shareholders. The so known as augmented payout ratio, which incorporates proportioned paybacks, in addition to dividends, has been better than 100% in the course of a few years, which essentially manner that Apple is dispensing extra cash than it earns. 5. When to sell. Holding on to your investments indefinitely is one of Warren Buffett's core concepts for successful stock investing. However, there are 3 situations in which you should consider selling a stock. Number 1. More is required for a better investment. There are so many opportunities to go around at times, perhaps notably in bear markets, that you must consider switching from something outstanding to something exceptional. 2. When a company's competitive advantage may be threatened. The times have changed. The traditionally monopolistic qualities of local newspapers, for example, are increasingly being undermined by online media. If one of your investments is exposed to this kind of danger, it may be time to sell it. 3. During periods of exuberant bull markets, even a great business can be a bad investment if you have to pay an astronomical amount to get it. Similarly, there are situations when selling a wonderful business at such a low price might help you improve your personal finances if you already own one, even if you believe in the company's fundamental economics. Buffett and David Clark recommend that you sell your equities if the PE ratio is 40 or above. So, which of Warren Buffett's financial statement interpretations did you find particularly useful? Please let me know in the comments section below. And if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.